Okay, today in this lesson we're going to talk about the Forex major pairs, 28 currency pairs total, and various currency pair characteristics, volatility, price movement, spreads, things of that nature. And this is one of our 35 lessons on our website at forexearlywarning.com. So a Forex major pair is a currency pair that has the US dollar on the left or the right. So some examples would be like the British pound USD, the Euro USD, Aussie dollar USD, New Zealand dollar USD. These are Forex major pairs. Now, with our trading system, the Forex early warning trading system, we trade a total of 8 currencies: US dollar, Canadian dollar, etc. All these currencies right here. And just remember that the 3 most actively traded currencies, individual currencies, in the Forex market is the US dollar, the Euro, and the Japanese yen. So the 8 currencies we trade can be combined into 28 pairs. So you have your most frequently traded major pairs, Euro USD, USD yen, pound USD, and then you have your most frequently traded non-major pairs. A non-major or exotic pair would be something with the US dollar not on the left or the right, Euro pound, Euro yen, Euro yen, Aussie dollar, Canadian, stuff like that. It's the same 8 currencies but different combinations. From a trader's perspective, you want to know when currency pairs move and why. All 28 pairs can move in the main trading session, including all the Forex major pairs. There's 2 trading sessions. There's the Asian trading session, and then there's the main trading session. So sometimes the Aussie dollar, New Zealand dollar, and yen pairs can sometimes move in the Asian session. After the news drivers that occur there, you can look at the Forex news calendar. We even have an article here on how to trade in the Asian session. And then in the main trading session, all of 8 currencies and all 28 pairs could move. So why do currency pairs move? Currency pairs only move because one currency is strong and the other currency is at least neutral or weak. So any currency pair, if the US dollar is strong and the Canadian dollar is neutral or weak, the US dollar Canadian is going to go up. That's true for any Forex major pair or all 28 pairs. And using this simple fact, right here, one currency is strong, the other one is neutral or weak, can give you a preview as to how you can trade all of 28 pairs you see, including the 7 major currency pairs. So how do you trade the major pairs and also the exotic pairs, the non-majors, profitably? You have one currency strong and the other one weak. That would be a great start, and then you can start looking at trading these pairs. So look at this example here. This is an example for the Aussie dollar USD, but this is the exact same logic you can apply to all 28 pairs. So we have this real-time tool called the Forex Heatmap, and you can see the Aussie dollar is either the base currency or the cross currency. You can see that the Australian dollar is strong. This is a live tool that works for 8 different currencies. Because the Australian dollar was strong, and there was some very slight US dollar weakness, the Aussie USD moved the fastest. So you had this nice 90 pip move off these live signals. And now you're talking about building a trading system off of some strong indicators, some very simple trend indicators that we have on our website. This is what Forex traders need. They need a clear indication of what pair to trade and a clear indication of how to enter the trade. These multiple breakouts here throughout a 90 pip cycle. So this is 90 pips. This isn't some 10 pip cycle. Let's look at the pricing right here. And remember, this same system works for 28 pairs, all of the major pairs plus 21 exotic currency pairs. So when you look at the percentages, what do these percentages mean? You got to look at the volatility and price movement. So you got to go to your quotation systems. Here's one of the 28 pairs. What does a 1% movement mean? Well, all you have to do is move the decimal point 2 places to the left, 2 places to the right. You can see that a 1% movement on the Canadian dollar Swiss is 75 pips. Well, if you go to the Euro USD, a 1% move is about 114 pips if the bid or ask price is 1.1375. Once again, you just move your decimal point. One of the 28 pairs we trade is the pound New Zealand, which is much more volatile. So if you look at the quote price, 2.2986, a 1% move in the pound New Zealand is 230 pips. That is vastly different than 75 pips. It's 3 times more volatile than Canadian dollar Swiss. So just by doing this simple trick, the 1% rule of volatility, know what a 1% movement is, you can estimate the volatility of any currency pair. And so if you get strong trading signals, you can estimate the type of price movement you'll get and start making comparisons between the 28 currency pairs. Go back to the lesson here. Okay, so there's your 1% rule for volatility. And then you have quotes and swaps and payouts and spreads and all, there's a lot of different characteristics of these pairs. Okay, payouts, but Forex traders are really concerned with the spread. Here's some example spreads. This is information from a major broker for a direct access trading platform. And if you look, you can see what is the pair that has the lowest spread. What's the Euro USD? That's because it has the highest trading volume every day. But look, the Euro New Zealand is 4.1 pips. So that means that there's a less of volume of this pair traded every day. So go check this out, and then check your trading platform and see if you're getting a good deal on your dealing rates. I would check these spreads against the ones you should be getting in the main trading session. The spreads might be wider in the Asian trading session. Okay, remember that all 28 pairs that you trade can trend up and down. All 28 pairs, including the major currency pairs, can range. They can be choppy. So those types of characteristics are similar and can be easily seen on a set of charts. On a trading system like this, a really great signaling system and very simple trend indicators, you can trade all 28 pairs. You can day trade all 28 pairs. If one currency is strong and weak, you can, if the market is trending, you can stay in the trade. So if, let's say, this Aussie dollar USD is trending up on the D1 time frame, a bigger time frame, this is a smaller time frame, you can scale out lots when it stalls on an intraday basis and then stay in the trade and then start riding the trend in the direction. If the trend is up on the D1 time frame, you can start riding the trend. You can enter the trade here, scale out some lots here, and then set your stop to break even back near the entry price. And now you can start riding the trend. So remember, all 28 pairs, including the major pairs, can trend. So this opens up a wide range of possibilities. You can now trade 28 pairs. You know the volatility of the pairs. You know the spreads. You know the payout. You know why currency pairs move. And so, and you have some simple, easy to understand signaling systems to get you trading across the major pairs and the currency pair characteristics that we've covered. So this is the major pairs plus the exotic currency pairs, 28 pairs total. Okay. And some of the currency pair characteristics like volatility spread that you need to know for trading them. And this is part of our 35 Forex lessons here at forexearlymorning.com.